One of the most confusing and contradictory pieces of advice in personal finance is what bank accounts you actually need. And just by listening to advice on social media, you would think you need 100 accounts to get your financial life together. But here is what the people who actually built wealth know that most people do not. They never keep all their money in one place. However, there are only a few accounts you must have to build your wealth. Hi, I'm Ayana, and today I am walking you through the 6 accounts you need to build wealth. Now, one thing the wealthy know is that money loves structure and correct flow, and that is essentially what these 6 accounts do. They structure your income, regardless of how little you think it is, to ensure it multiplies and builds you wealth. The first account on this list is the one we already know, the checking account. Now, do not roll your eyes like I thought you were giving me a wealth building account. Your checking account is important because it is the foundation of your financial system. Your checking account is not powerful because it grows your money. It is powerful because it is the first place your money lands. But where most people get it wrong is that they do not understand its function and how it should be structured. The true goal of a checking account is movement, not holding, and its function can be divided into 3 things: income inflow, bill payment, and spending. That is all. The mistake most people make is that they use it as a holding account for everything else. The only money that should stay in your checking account is the money already assigned to bills and spending for that pay cycle. So that is for the next 2 weeks or 4 weeks, depending on your specific pay cycle. Everything else gets moved out to one or more of the other 5 accounts we will be discussing. Now, you can leave all your movement money as one lump sum in the checking account, but some banks now let you create what are basically sub accounts inside the same app. This allows you to separate money for different purposes without opening a completely different bank account. So you can have a bill sub account where you keep money for essentials like rent, groceries, utilities, transport, insurance, phone bills, minimum debt payments, and any essential physical upkeep that keeps your life functioning. Then you can create a spend sub account for the non-essential things that make life enjoyable. A lot of people leave this at 0 and then wonder why their budget does not work. If your budget leaves no room for normal human wants, eventually you will crack and blow the whole budget. So this can cover things like eating out just because, entertainment, hobbies, social plans, small personal treats, non-essential shopping, and so on. The only word of caution is that the size of your spend budget has to be based on the reality of your income. You may not be able to afford every want right now, and that is okay. What matters most is building your wealth, and as you build it, your spend budget can increase to match your new reality. So let's make this practical. Say you are paid every 2 weeks and $2,500 in net income lands in your checking account. Before you spend anything, you subtract half of your monthly bills. Let's say that comes to $900 for rent, $180 for utilities, $250 for groceries, $120 for transport, $100 for minimum debt payments, and $200 for spending. That brings your movement total to $1,750 and leaves you a balance of $750. That $750 gets moved immediately on payday. The only money that should remain in checking after payday is the $1,750 already assigned to bills and spending for that pay cycle. Your checking account is not where your money grows. It is where your money gets its orders. Now, the next account cannot be skipped. Remember, money loves structure and correct flow. So this must be your second account, and that is a high yield savings account, also known as a HYSA. This is our first real wealth building account. It is essentially a savings account, but much better than a standard savings account because of the interest rate. The function of a HYSA can be divided into 2 things. First, it stores safe cash that you may need unexpectedly or money you already know you will need later but not immediately, like your bills and spending. Second, it helps that cash grow while it sits there as you're enjoying compound interest. Now, what makes this account so special is the difference in interest compared to a normal savings account. According to FDIC data from April 2026, the national average savings account rate was around 0.38% APY, but many high yield savings accounts are paying around 4% to 5% interest. So let's compare. Say you have $5,000 sitting in a regular savings account. At 0.38% after 1 year, you would earn about $19. Yes, $19. Now take that same $5,000 and put it in a high yield savings account, earning 4% to 5%. At the end of 1 year, you would earn between $200 and $250. That is more than 10 times the return, just because the money was sitting in a better place. And the kicker is that you can access your money easily when you need it. That is why this account is so powerful in your wealth building stack. It gives your safe money a better home. Remember, I said that the first function of a HYSA is to store safe cash that you may need unexpectedly, or money you already know you will need later but not immediately, like your bills and spending. Well, money you may need unexpectedly is your emergency fund, and money you already know you will need later but not immediately is your planned future spending, which is where sinking funds come in. So that gives the HYSA two major jobs. The first job is to hold your emergency fund. The second job is to hold your sinking funds. Your emergency fund is simply a cash cushion that helps make sure a bad day does not turn into a bad financial decision you will still be paying for long after. Your emergency fund is kept specifically for genuine emergencies: a medical bill that arrives without warning, a family situation that needs immediate money, a car repair you cannot avoid, a sudden job loss, anything that can knock your life off balance if you do not have cash ready. An emergency fund helps make sure you do not immediately reach for a credit card, fall into high interest debt, and derail your entire wealth building journey over a problem that cash could have solved. Now, here is the target most people get wrong. People hear 3 to 6 months of expenses and immediately feel overwhelmed, so they never start. But that is not how to think about it. The real first goal is $1,000. $1,000 sitting in your high yield savings account, untouched and earning interest. That single buffer will not solve every crisis, but it can stop many everyday financial emergencies from turning into debt. That is the starting milestone. Once that $1,000 is in place, and once you have cleared any high interest debt, then you can come back and build towards 6 to 12 months of essential expenses. That is the full emergency fund goal. The second job your high yield savings account does is hold your sinking funds. Now, a lot of people get confused about what this really is. Some people confuse it with an emergency fund, but they are not the same thing. A sinking fund is not for an emergency. A sinking fund is for an expected, non-immediate expense. A sinking fund is basically money you set aside every month for an expense you already know is coming. Read that again. An expense you already know is coming. Your car insurance renewal, Christmas, a wedding you are planning, a house deposit, school fees, annual subscriptions, a friend's wedding, a baby fund, car maintenance, travel, and so on. None of these are real surprises because you already know they're coming. But without a dedicated fund collecting money toward them month by month, they arrive and feel like emergencies. And you find yourself reaching for a credit card, borrowing money, or pulling money from another account on this list where it should not be touched. Here's what this looks like with actual numbers. Let's say you have met the love of your life and you are planning a wedding 2 years from today with a budget of $12,000. That is $12,000 divided by 24 months, which means $500 a month going into a dedicated wedding sinking fund starting immediately. Or say you want $30,000 for a house deposit in 3 years. That is $30,000 divided by 36 months, which means about $834 a month. And sinking funds are not only for big dreams, they are also for recurring expenses. If your car insurance renewal is about $2,500 a year, that is about $208 a month you should be setting aside before the renewal shows up. And the same thing applies to Christmas gifts. If you know December comes every year, Christmas should not be attacking your finances like it came without warning. You can create a Christmas sinking fund in January and let it build quietly all year. That is the peace of mind this account gives you. When those dates arrive, the money is already waiting. So essentially, emergency funds protect you from a crisis. Sinking funds protect you from the habit of pretending predictable expenses are surprises. And while that money is sitting there, the HYSA is paying you interest. Account number 3 is a major wealth building account, and yet it is one most people have never heard of. And for the people who do have access to it and have no idea what it actually does, it might be the most expensive gap on this entire list. It is called an HSA, a health savings account. Now, before we go any further, not everyone can open one. The HSA is the only account on this list that has an eligibility requirement before you can contribute to it. To qualify, you need to be enrolled in what is called an HSA eligible high deductible health plan, which is basically a specific type of health insurance that carries a higher deductible than a standard plan. So the very first thing you need to do after this video is check your health plan. Because if you qualify and you are not using this account, you are leaving one of the most powerful tools in personal finance completely untouched. Now, if you do qualify, here's what you're actually sitting on. A health savings account is essentially a tax advantage account designed to help you save and pay for qualified medical expenses. But calling it just a medical account would be like calling a Swiss Army knife just a knife. The HSA does significantly more than that. The function of an HSA can be divided into 3 things. First, it covers your qualified medical expenses tax advantage. Second, it grows your money through investing tax-free. Third, it functions as a retirement account after age 65. Now, what makes this account so special is something called the triple tax advantage. And when people use that phrase, they almost never explain what it actually means. So here it is plainly. 1, the money you put in goes in with a tax advantage. If your contributions come through your employer, they are typically pre-tax. If you contribute yourself, they may be tax deductible. Either way, putting money into your HSA reduces your taxable income. 2, the money inside the account grows tax-free. Any interest it earns, any investment returns, none of it is taxed while it sits there. 3, when you take money out for a qualified medical expense, it comes out completely tax-free. No taxes going in, no taxes on the growth, no taxes coming out for medical use. No other account on this list does all 3 at once. The HSA is the only one built this way. Now let us talk about what actually qualifies as a medical expense, because this list is broader than most people realize. Doctor visits, prescriptions, dental work, eye exams, glasses, contacts, therapy, certain over-the-counter medications, and other qualified medical bills. This is not a narrow list of obscure categories. This is the normal everyday cost of taking care of your body, and the HSA covers all of it tax-free. So let us make this practical. Say you visit your doctor twice a year, pick up a couple of prescriptions, and get your dental cleanings done. All in, your out-of-pocket medical costs for the year come to around $640. Now, if you pay that $640 straight from your bank account, you are paying with money the government already taxed. Depending on your tax bracket, you may have had to earn $800 or more just to have $640 left to spend. That $640 bill actually costs you closer to $800 of your real income. But if you pay that same $640 from your HSA, you are paying with money that was never taxed at all. You contributed $640 pre-tax, meaning you only needed to earn $640 to have $640 available. The bill costs you exactly what it says it costs. That is the power of the HSA for medical expenses. And that is before we even talk about what happens when you invest the money inside it. Now, here's where it gets more interesting. Say you are 30 years old and you start contributing $200 a month to your HSA and leave it fully invested in an index fund. At 10% average annual return, which is close to the long-term historical average of the S&P 500, by the time you reach 65, that account could grow to around $760,000, and you only contributed $84,000 of your own money. The rest is growth. Think about what that means. You are building an investment account where the growth is never taxed. The contributions potentially reduce your taxable income, and any withdrawal for medical expenses comes out clean. That combination does not exist anywhere else in the personal finance system. The third function, the one almost nobody talks about. After age 65, the HSA starts behaving like a traditional retirement account. Before 65, if you take money out for something that is not a qualified medical expense, you pay income tax on that amount plus a 20% penalty. That penalty is significant and it is there for a reason. But after 65, that penalty disappears entirely. From that point, withdrawals for non-medical expenses are taxed as regular income, exactly like some other retirement accounts. And withdrawals for qualified medical expenses remain completely tax-free forever. So what you have is an account that pays for your health care now, grows your wealth tax-free in the middle, and functions as a retirement account at the end. The mistake most people make is treating the HSA like a medical debit card. Every copay, every prescription, every small bill, swipe, swipe, swipe. They drain it every single year and never give it the chance to build and grow. And to be clear, if you need the money for medical bills right now, use it. That is exactly what it is there for. But if your situation allows you to pay current medical expenses out of pocket and let the HSA compound, what you are quietly building is one of the most tax-efficient accounts available to anyone. Account number 4 is the 401k, and depending on where you work, it might go by a different name. If you work in education or for a nonprofit, yours might be called a 403b. If you work for the federal government, it is called a thrift savings plan. The names are different, but the structure and purpose are essentially the same. A 401k is essentially a retirement savings account your employer gives you access to, where money is taken directly from your paycheck before income tax is applied. One thing I love is that it is taken out before your check is sent, so you never see it. You never have to decide whether to save or spend it. The decision is already made. And that is not a small thing, because the hardest part of building wealth is consistently choosing it over everything else competing for your money. The function of a 401k can be divided into two things. First, it builds your retirement wealth with a tax advantage. Second, it allows your employer to add free money on top of your own contributions. And because your contributions go in pre-tax, every dollar you put in reduces your taxable income for that year. So if you earn $60,000 and you contribute $3,600, the government taxes you as if you earn $56,400. You are not avoiding the tax forever. You will pay it when you withdraw in retirement, but you pay it then potentially in a lower tax bracket rather than now. Now let us talk about the employer match properly, because this changes the number significantly. So let us make this practical. You earn $60,000 a year. Your employer offers to match 50% of your contributions up to 6% of your salary. You contribute 6%. That is $3,600 from your own paycheck. Your employer adds $1,800 on top. Your total monthly contribution going into that retirement account is $450 and $5,400 for the year. And $1,800 of it costs you nothing. Not contributing enough to capture your full employer match is the same as leaving part of your salary uncollected every single month. Now, here's what that actually means over time. Say that $450 a month goes consistently into a simple index fund for 35 years. At 10% average annual return, that account grows to about $1.71 million. You contributed $189,000 of your own money. The rest is growth and the employer contribution doing exactly what they were designed to do. For 2026, you can contribute up to $24,500 a year. If you are 50 or older, that limit increases to $32,500. And if you are between 60 and 63, you can go up to $35,750 as an opportunity to catch up. However, your employer is not the only doorway into retirement investing, though, and that is exactly what Account 5 is about. Account 5 answers a question a lot of people never think to ask. What happens to your retirement investing if you change jobs, if your employer offers no plan, if you are self employed, or if you simply want retirement wealth that nobody else controls? This account is called a Roth IRA, an individual retirement account, and it is essentially a retirement account you open yourself, completely independent of where you work. Here's how it works in plain terms. A Roth IRA is funded with money you have already paid tax on. If you're employed, that is the money that lands in your account after your employer has taken taxes out. If you are self-employed or run a business, that is your income after you have settled your tax obligations. Either way, the government has already taken their share before the money goes in. Now, here is why that matters. Everything that money grows into, every dollar of returns, every year of compounding is never taxed again. Not while it is growing inside the account, not when you take it out in retirement. The government was paid once on the way in, and that is the end of it. Now, there are a few rules you need to know. The growth inside your Roth IRA cannot be touched without penalty until you are 59 and a half. For 2026, you can contribute up to $7,500 a year. And if you are 50 or older, the limit goes up to $8,600 a year. That extra allowance exists specifically for people catching up on their retirement savings. So if you feel like you started late, the account actually makes room for that. Now, before you open one, here is the most important advice on this account. Do not start contributing to a Roth IRA while you are still carrying high interest debt. Here's why the math works against you. Say you have $5,000 in credit card debt at 20% interest, which is around the current average. That debt is costing you $1,000 a year. That same $5,000 invested in a Roth IRA at 10% makes you $500 a year. You are still losing $500 every single year. The debt exists. The debt is growing faster than the investment. Pay the high interest debt first, then open the Roth IRA. Also important to note is you do not have to choose between this and your 401k. You can have both running at the same time. But what happens when you want to invest beyond the allowed limits for both or build wealth you can actually access before retirement age? That is what account 6 is built for. Account number 6 is the one most people either ignore completely or open before they are anywhere near ready for it. It is called a taxable brokerage account, and the name alone puts people off. It sounds technical. It sounds like something that belongs in glass offices, skyscrapers, and conversations with people wearing expensive suits. But it is actually very simple, and at the right time, it should be part of your financial system. A taxable brokerage account is essentially an investment account where you can hold stocks, index funds, ETFs, and other assets completely outside of any retirement account structure. The function of a taxable brokerage account comes down to two things. First, it lets you invest beyond the limits of your retirement accounts. Second, it gives you access to your invested money before retirement age without restrictions. Think about where we are. Between your 401k and your Roth IRA, you can shelter up to $32,000 a year from tax. That is significant. But if you want to invest more than that, or if you simply want wealth you can reach before you turn 59 and a half, your retirement accounts cannot do that job. A taxable brokerage account can. There are no annual contribution limits, no age requirements, no rules about when you can take your money out. You invest, it grows, and when you want it, whether that is in 10 years or in a week, you can access it. Now, here is the trade-off, and it is important to understand before you open one. This account is called taxable for a reason. When you sell an investment for more than you paid for it, the profit is called a capital gain, and that gain is taxed. How much depends on how long you held the investment. If you sell within a year, that gain is taxed as regular income, the same rate as your salary. If you hold for longer than a year before selling, the tax rate is lower. So the longer you leave your investments untouched, the less tax you pay when you eventually sell. So let us make this practical. Say you have maxed out your 401k and your Roth IRA for the year, and you still have $6,000 left to invest yearly. That is $500 a month. In a taxable brokerage account at that same 10% average annual return, after 30 years, that account will grow to around $1.13 million, with your total contribution being only $180,000 of your own money. That is wealth you can reach on your own timeline. Not at 59 and a half, not at 65, whenever you need it. Now, the mistake with this account goes in both directions. Some people avoid it entirely because, like I said earlier, it sounds advanced, or because they associate it with active trading and complexity they do not feel ready for. But it does not have to be complicated. Warren Buffett, widely considered one of the greatest investors of all time, has repeatedly said that for most ordinary people, putting money into a simple low-cost S&P 500 index fund, which has been used in all our examples on this list, is one of the smartest financial decisions they can make. You do not need to pick stocks. You do not need to watch the market every day. The account can be as simple as one fund and patience. And the other direction is some people open one before the foundations are in place. There's no point building wealth in one account while you have high interest debt charging you somewhere else. Clear the debt first. Build the foundation, then open this account. Your retirement accounts build wealth for later. Your taxable brokerage account builds wealth you can reach on your own timeline. And those are the 6 accounts you need to start building wealth. So here's the full system. Your income lands in checking, bills and spending stay there. Emergency funds and sinking funds move to the HYSA. Medical wealth goes to the HSA if you qualify. Retirement wealth goes to the 401k and Roth IRA. Flexible long-term investing goes to the taxable brokerage account. Now, I want to say this so you are not overwhelmed. You do not need to fix your entire financial picture today. You just need to give the next dollar a better job. Building wealth is not only about making more money, it is about building a system where every account knows its role and every dollar knows where it belongs. That is what the people on the other side of wealth figured out. And now you have the same map. Thank you so much for watching all the way through. If this video gave you clarity, do me a favor and subscribe. And if you found this useful, share it with someone who needs to hear it. It might be the most valuable thing you do for them today. I will see you in the next one.